Okay, a Roth, you get no deduction. Not going to fix anything this time, not going to give you anything better. But if you believe that your money is really going to grow and that your tax bracket is not going to be less, it's going to be more when you retire, these are a good deal. Okay, if you're not looking for the current write-off, if you're looking for growth and to be able to take the money out or to not have to take the money, because unlike a regular 401k or IRA, turn 70 and a half, you have to start taking money out of this stuff. Okay? You have to take money out of a Roth. You can leave it. And if your kids inherit it, they don't have to pay income tax when they take it out. Okay, now it does count towards estate tax. Oops. Let's go back. Distributions are tax-free in retirement. I had Roths for my kids because they were always working here. And when they were little, they made $5,000 or $6,000. Their money went in their Roth. They had their Roths at least 5 years. When they went to college, they could take back out of that Roth. They couldn't take the growth, but they could take out of their Roth all of the money we had put in and leave what was growing. And they didn't have to pay a penalty. They didn't have to pay tax. And we arranged for that because when they went to college and they said, you know, Dad, I really want to date. I would have got more money. The girls were cheaper actually in college because, you know, they let the boy pay for dinner, I guess. But, you know, when they needed money, it came out of there. They were spending their money that they had put away and that they had earned. So a Roth can be a really good thing. Roths, now everybody can't do a Roth, okay? And you might not be able to deduct what you put in there. Everybody can't do a Roth. But you can make after-tax contributions to the Roth, the same as the IRA. When you take it out, you got to leave it at least 5 years. You're over 59 and a half, you're going to get the distributions tax-free. So that works, okay? But the contributions are reduced or you're ineligible. Now, this is really interesting because I have clients that want to fund Roths and don't have any money to put in them. Well, the rules say that you can convert any regular IRA to a Roth IRA. That's neat. At any time, and there used to be limits. If you made too much money, you couldn't do this. Now you can convert it no matter how much you make. So those clients do a non-deductible IRA. They can put their $6,500 in it, and we put it into the money market in the non-deductible IRA, and then we immediately convert the non-deductible IRA every year to a Roth IRA. They didn't get the deduction anyway for the non-deductible IRA. They just won't let me put it right into the Roth IRA. The government likes me doing some extra paperwork. Okay? So you can do the conversion. If you have other money that you want to convert, this is I had a client last year that said, I had a really bad year. I lost all this money. I'm not going to have made anything. And I got all this money sitting in my regular IRA. And they said, well, I've got this loss. What am I going to do? We said, okay. We're going to take, you've got $300,000 in your regular IRA, we're going to take $75,000 of that and we're going to convert it. And the $75,000 will offset your loss and you'll have a little bit of taxes, but not much. You know, most of that money came out tax-free and now it's growing tax-free. So in a year that's bad, rather than trying to carry the losses back or think, am I going to carry them forward? Or when am I going to use those losses? I might use them to convert my regular IRA to a Roth IRA, okay, and allow it to start growing tax-free. When you convert, if you don't have that loss to use up, it is going to create taxes. Okay, the other thing that people tell me, I got to take money, I had to take money out of my IRA, and I'm taking money out of my IRA, and it's pushing up what I have to pay in tax on my Social Security because I'm older. Well, you're already paying tax on 85% of your Social Security. We can do a lump sum conversion. And then next year, you won't have to take any money out, and it won't make that Social Security taxable. So there's a lot of planning stuff you can do. If you sit down and you say, gee, what do I have? What am I making? What if I change it? Would I be better off paying now? Would I be better off paying later? I don't want to pay on the Social Security. I do. Let's take more of it. Let's take less of it. Okay? You don't owe a penalty if you do the conversion. There are no penalties on the amounts converted.